So the accounting cycle, they call it, that's the sequence of activities that occur in the accounting process. And we'll talk about that now, right? From the occurrence of a transaction through generating financial statements. There's like 12 steps that you do in every single, it's like a checklist. So you don't miss a step, you don't mess up. And the occurrence of a transaction, remember we talked about the matching principle. That's what we consider a transaction where you have a revenue and some sort of expense at the same time. So the first thing is the recognition of an event as a transaction. And so you identify the source, you have some kind of a document, right? A receipt or a bill or an invoice or a check, something that says something's happened, right? And then you decide what the heck is that thing, right? So that next step is analysis. What the transaction, which accounts is it going to affect? So if it's an invoice from your landlord, and okay, now we got to pay rent. That's going to affect cash. We're going to reduce cash, and we're going to the expense will be the landlord, right? So then you have your journal entries, and the journal entries is where the transaction's actually recorded as a debit and credit. And a transaction can have more than one debit or credit, right? It can be, say if it was you bought a truck and you paid for half of it with cash and half of it with a loan, then it would affect three accounts, right? One would be the asset, and one would be your cash account, and one would be creating a liability, a loan account. So it can be more than one, but the credits have to equal the debits. So then you make that account, you post it to the ledger, and that's that thing. The T accounts are basically the general ledger where you say, here's the debits, and here are the credits on the account. And then from there you make a trial balance, right? And that's a balance of all the accounts. That's when you generate your financial statements for the first time, and see if they're balancing. And then you make some adjusting entries after that for accrued items, for your accounts payable, your depreciation, those kind of things. The operations section of the cash flow thing, right? The ones that are non-cash payments, where now you have to add your depreciation, now you have to increase, this or that. And then that's called the adjusted trial balance. And from there, you prepare financial statements. And in QuickBooks or something does a lot of these steps. These steps are sort of like even old school if you were doing it by hand, with writing them in a ledger book or something.
I think of Ebenezer Scrooge.
That's what I always think of, is Ebenezer Scrooge and Bob Cratchit, sitting at those tables. But that's how people used to do it,
Well, in your book you said you had to be pretty freaking smart, and I agree with
You
that.
did, yeah.
I have big spreadsheets, and they still get messed up, and that's a spreadsheet calculated, and I can't imagine doing it by hand.
By hand, and then trying to find where the mistakes were made and stuff,
God.
or where you might have transposed a number, all those kind of things. It gets, but with QuickBooks, it's almost foolproof in a way, and you make a lot of mistakes, but not like it was back in the day.
I remember Ebenezer Scrooge. That makes perfect
Yeah,
sense.
and if you enter anything in Perla, I'll be like,
Yeah.
whoops, I did something wrong.
Is that what?
Mine makes like
A sound?
yeah, which is always
Wrong.
nice, yeah, idiot.
We've got all those we have old bank books. We have a lot of these old branches, and you just go in back, like where they're storage, and you just find these old books just full of all that.
Ledger, but back from the 60s or 70s or 80s, it was all done that way. And
Yeah.
and then there was one of the big things was, just calculators where you could do this kind of stuff, right? Remember those? Where you do it by hand and all?
There's Abacus.
Abacus was
Tellers
very
like,
old.
Back in the day, had those things at their teller station.
Yeah, no, absolutely. That was a simple way to do. In fact, there was like races back in the day, like John Henry and the, trying to beat the automated railroad machine. It's like abacus guys versus computers and calculators and stuff, and they could do it just as fast. Yeah, because that has 5. It counts in different. And slide rules were the other thing we were calculating. Then when calculators came along, it really made it so much easier. But then we atrophied our ability to even guesstimate the range of a number. And if it comes out on the calculator, well, then we say that's right, even without thinking, wait a minute, is it tens or hundreds or thousands? How big should it be? Or, during World War II, they did a lot of efficiency things for like bombing raids and stuff, and they didn't have computers. They had human computers. They'd have rooms of people with those adding machines with the cranks on them, and each one of them would take a process in the calculation.
That's great.
Yeah, and that's how they did it, and they'd have hundreds of people, doing this all day, calculating these things that now can be done really fast with a computer.
Wow.
But in college, this was with me. For my college, I learned how to make all of these financial statements by hand, like writing,
Wow.
like all of that, like 4 years.
Wow. That makes it better as far as you understand how they're put together. And that's really important, because when you're just putting in the numbers and all and you don't really know how it goes, it's really good. But it's nice not to have to be able to do that.
Well, I
right?
remember all the T accounts, doing all those things where you had to make
Yeah.
a T account and
Make
we
a T
wondered why
account,
you
put the
did it,
debits
but
and credits, and
like
that's
you
what
said,
it was.
because
Yeah.
you need to know what QuickBooks is doing behind the scenes.
Yeah.
That's so true, because when I started my job, it was like I couldn't see the forest through the trees, because it was just, you would be learning these little pieces.
Right, and how do they-
Like,
what's the
see how
context?
it
Yeah, all fit together.
For a while, and then, now I get it.
I think that's the problem with accounting. I think the way it's taught is sort of backwards, where you start with the debits and credits and T accounts, and it's like, what am I doing? Instead of like, you're making financial statements, and then these are the parts of it and stuff, and then
Well,
then
didn't
you
that's
kind
you
of
say you told us, that's why, and it resonated with me, you said that you're talking to some people with MBAs, you're like, well, what's the financial statements? And they're like, I don't know, but they could tell you.
They're
an
clueless.
accountant- Yeah, clueless. So
Yeah.
you learn these silos through school, but
Right.
you don't realize you can't put them together in
Right.
a full picture.
and synthesize them, and that's what you
Synthesize
ultimately
them.
have to be able to do.
And this is making a lot more sense now. I wish I would have known this, because I did this 16 years ago, and I wish I would have. It makes so much more sense because I've done it now in a corporation. So it's like, God, this is so much. It's refreshing to see this, because
Mhm.
I didn't understand it. I was just doing the motions to get the degree, obviously. So it's nice, yeah.
Excellent. No, so then you make the financial statements, right, and then you close that out. The one thing to think about with this is the income statement, right? The revenues and expenses, those accounts, those are what we call temporary accounts. They don't, after you make a new balance sheet for a particular time period, you're basically closing out and re-zeroing all those revenue and expense accounts, right? Because